For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Today we will talk about whether or not Palantir Technologies could be the key to retiring as a millionaire. This is a question many investors are asking, given the company's astonishing recovery since its initial public offering. In the aftermath of its debut, Palantir saw its shares skyrocket before facing a severe downturn. At its lowest point, the stock had plummeted by over 80% from its early 2021 peak. This sharp decline was not entirely surprising, as macroeconomic headwinds battered the entire tech sector during 2022. However, Palantir faced its own unique challenges, as investors expressed significant concerns about its ability to turn a profit, leading to a steep drop in its valuation. Fast forward to today, and Palantir's story has taken a remarkable turn. The company has silenced many critics by proving its ability to generate strong profits. Moreover, it has consistently delivered double-digit revenue growth every single quarter. This combination of profitability and steady growth has transformed Palantir into a company worth watching closely. This transformation has not gone unnoticed by investors. Over the past 2 years, Palantir's stock has experienced a staggering rise, increasing by more than 11-fold. Such growth naturally raises the question, can an investment in Palantir help secure financial independence? While Silicon Valley continues to promise revolutionary technologies, accompanied by soaring stock valuations and massive investments in artificial intelligence infrastructure, many investors remain skeptical. They want to see tangible results, real-world applications of artificial intelligence that deliver undeniable value. Palantir is a standout player in this regard. The company's name, inspired by the Seeing Stones from Tolkien's Lord of the Rings series, aptly reflects its mission. Palantir is an intelligence-focused company that leverages artificial intelligence to help its users see through the overwhelming noise of data. Its software is designed to extract meaningful insights from massive, complex datasets that traditional methods often fail to process effectively. What sets Palantir apart is the remarkable adaptability of its products. These tools are not confined to a specific industry or application. Instead, they can be deployed across an incredibly diverse range of sectors. Palantir boasts an impressive roster of clients spanning government agencies and private enterprises. For instance, its software has been used by the Central Intelligence Agency and by Ferrari's Formula One racing team. This versatility and effectiveness have made Palantir's services highly sought after, particularly within the United States. Domestically, the company has seen its commercial sales surge by 54% year over year. At the same time, its government-related sales within the US have grown by 40% year over year. Together, these two segments have driven Palantir's overall revenue to grow by 30% year over year. Beyond revenue growth, the company has also achieved significant improvements in profitability, expanding its net margins by over 50% and doubling its earnings per share compared to the previous year. This level of execution is nothing short of extraordinary. However, while Palantir's operational performance is undeniably impressive, a major concern looms over its valuation. The company currently carries a price-to-earnings ratio of 376, which represents an extremely high premium. To put this into perspective, major players in the tech industry, such as Alphabet and Microsoft, have price-to-earnings ratios of approximately 30. Admittedly, comparing Palantir to these mature tech giants is not entirely fair, as their growth trajectories differ significantly. However, even when compared to high-growth peers, Palantir's valuation remains in a league of its own. For example, ServiceNow, another high-growth company, has a price-to-earnings ratio of 166, less than half of Palantir's. To better understand the implications of Palantir's valuation, let's consider a hypothetical scenario. If by the year 2035, Palantir achieves a price-to-earnings ratio of 60, a figure that would still be considered generous for a software-as-a-service provider, it would need to maintain its current annual growth rate of 30% without fail for the next decade. Under these conditions, Palantir's stock would only match the historical average annual return of the broader market, which is approximately 10%. In other words, even if Palantir performs exceptionally well, it would merely deliver average returns to investors. Of course, there is always the possibility that Palantir could exceed these assumptions. The company might achieve higher growth rates or sustain its premium valuation for longer than expected. However, even with generous assumptions, such as maintaining a price-to-earnings ratio that is twice as high as today's leading tech companies, Palantir stock may struggle to outperform the broader market. So where does this leave investors who are hoping Palantir can help them retire as millionaires? At its current valuation, the stock appears to be too expensive to justify such hopes. However, this does not mean that Palantir should be written off entirely. The company's unique capabilities, strong execution, and growing demand for its services make it a compelling option to monitor. Should its valuation decrease meaningfully, Palantir could become a valuable addition to a well-diversified portfolio. In conclusion, while Palantir's current stock price may not align with the goal of achieving millionaire-level returns, its potential should not be ignored. For now, patience is key. Keep an eye on this company as it may present an attractive buying opportunity in the future. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.